In this lesson, we deal with the next important building block of technical analysis, the topic of price action. Price action is a vast field on its own. It's mainly about reading the information that a candlestick provides and placing it in context. You can read insights from a single candle or from a whole sequence of candles. We look at the basics you need for the rest of this course. Let's start from the beginning. What we see here are the so-called Japanese candlesticks. There are many ways to display price in the market. One popular form is a line chart, where we see how a stock, for example, performs. But there are many more types. The most popular form in trading is the Japanese candlestick. Here's how it's constructed. What you look at here is one such candle. A candle represents price movement over time. It starts at a certain price point and moves through different price levels. When the time period ends, the candle closes. In the red here, we start with an opening price. Then the price moves up a bit and it goes down to the lowest price. From there, it gets bought up strongly, reaching the highest price the candle ever saw, and then it gets sold again to eventually close at a certain level. This gives us 4 key price points: the opening price, the lowest price, the highest price, and the closing price. Every trading candle is composed of these 4. The concept is the following: if the closing price is above the opening, it's a bullish candle. If the closing price is below the opening, it's a bearish candle. In our example here, we have a bullish candle. It opened, was initially sold off, forming a lower shadow, then bought back up to the high, and finally sold again to a closing price, forming an upper wick. So we can name 3 points of the candle. We have the candle wick on top, we have the candle body, and the candle shadow. The body is the area between the open and the close price. Now we can understand that candle pass through this structure. The same logic applies for bearish candles. The only difference is whether the closing price is above or below the opening price. What's important? Price action is the market's reaction to a price level. It happens in every candle and defines the shape of each candle. Price action is therefore the act of reading candles and interpreting what the price level means to the market. Japanese candles come in many forms, and depending on their form, we can identify strengths or weaknesses of the candles and of the market. Here, I've listed some examples. We see bearish and bullish versions, basically mirrored forms. We start on the left. The first candle is very bearish. The market tried to push the candle up, but it was strongly sold off, forming a long upper wick. But the candle still has a bearish close. The second candle is even more bearish. It has a full body and there is no sign of any buying pressure here. No wick, no shadow, nothing. Just a full body close. This is the most bearish example there can be in the market. The third and the fourth option here are less bearish. The price dropped down, but buying pressure came in again, pushing the candle to a slightly higher close on the third option and a strongly higher close on the fourth. But they are nonetheless still bearish candles because they have their close under the opening price. Next, we come to the middle, the doji. A special type of candle is the doji. They have no real body and they form when the market moves in one direction, then reverses and closes exactly where it opened. Doji candles are hard to interpret and the context is very essential in those. Sometimes they mark a reversal, sometimes they mark a trend continuation. Now we come to the bullish candles on the right. The first one here again was pushed down first, then strongly bought back up, forming a long lower shadow and closing bullish. This shows strong buying pressure and is a very bullish example. The second one is also very bullish, with only a candle body and no selling pressure. Here again, no wick, no shadow, nothing. Just pure body and full bullish potential here. The last 2 are weaker again. The last candle is the weakest here. The market went higher, but strong selling caused a long upper wick. The candle is still bullish overall, but here we already see bearish price action and selling pressure coming back into the market. These are the basics of price action and candle shapes. Now let's take a look at patterns formed by 2 or 3 or more candles. Here are the 3 classic bullish patterns you should know. The first one is the bullish engulfer. We have a bearish candle here that is completely engulfed by a larger bullish candle. This shows strong buying pressure. Engulfing meaning we had a short candle here on the left and the next candle has to be a bullish one, and this candle has to close higher than the opening price of the bearish candle. Then those candles become engulfed. This is a very popular reverses signal. The second option is a twisted bottom. Those are two identical candles at the bottom of a downtrend. These signals balance between buyers and sellers, and it might mean that the selling pressure is coming to an end. Because if this candle formation is happening in a downtrend, we move down with a big bearish candle here on the left, and instantly after we see a bullish candle that also kinda engulfs the first one. So we see the bullish power coming back into the market here, basically. The last option I have here for you is the morning star. The morning star has a strong bearish candle followed by a small bullish candle and then a strong bullish candle that covers the distance of the first one. This one is also a very strong reversal signal. Let's take a look at the bearish patterns. Of course, these patterns exist in bearish forms too. Here we have the bearish engulfing. It's like the first one. We have a bullish candle at first, and the next candle is a bigger bearish candle which completely engulfs the bullish one. The second option is the twisted top. This one appears at the end of an uptrend and shows that selling pressure is coming back into the market and that the buying pressure is slowing down. And the last option here, the evening star. This one is the opposite of a morning star. It has a strong bullish candle followed up by a small bearish candle and then a strong bearish candle. There are many other variations though. For example, the middle candle of the evening star could also be a doji or whatever. But these are basically the three patterns of bearish and bullish you should know when it comes to price action, because they are most relevant and they are very popular. But price action should always be evaluated in the context of a market movement. Here's a small example. We see an uptrend with several bullish candles. At the top we have a candle resembling an evening star. The last candle was once bullish, but it closed bearish with a long upper wick. That's a clear sign of selling pressure. This triggered a move downwards with the next two bearish candles. In the second example, it's trickier though. Here we are in a downtrend. We have two bearish candles. The middle candle looks very bearish, but if we take a closer look at it, in the making of the candle, there was big bearish pressure coming into the market, resulting in a long upper wick. However, it shows that there's potential of bullish pressure in the market here. You might think this shows bearish strength now, but in reality, it can signal a reversal. Because if buyers are strong enough to counter heavy selling in a downtrend, then bearish pressure might be slowing down. What matters next are the following candles though. If they show bullish behavior, like here in the picture, the bearish trend may be over. So the market context is always key when evaluating price action. But let's take a look at the reward example and let's go into the market. Here we see a bearish market that moved into a demand zone. In that demand zone there's a lot of price action happening. There are many candles with long shadows here. Among them a bullish candle with a long upper wick appears. That wick shows strong selling pressure, but this pressure didn't lead to a new low. Instead, we saw a higher low form, which means the bearish force wasn't strong enough to push the market down. Not only did we not see a lower low, we also moved into the zone where the bearish pressure happened. So we moved up a bit afterwards. We ranged a bit here though, in this demand zone, and the market tapped the demand zone a few more times, and then we saw a break to the upside, right over the long wick. Now you ask yourself, why? Because retailers might have also put sell positions while the wick was there, or after the wick formed. They saw this big wick, this big bearish price rejection, and they thought to themselves, yeah, it's a good time to short. Maybe this demand zone is weak. But in the end, the market consolidated in the demand zone a bit longer. Thus, the institutions established more long positions here, and we moved above the wick now kicking all those short sellers out so we can close our long positions, or the institution can close the long positions with profit up there. We also see a bullish close above the wick, which confirms the bullish strength this demand zone provided to us. All of this can be interpreted through price action in market context. We need to interpret this price action with the market context to strengthen our own analysis before we enter a trade. That's why it's so important to always take a look at the price action and at the same time at the market context. See you later.